this week's Q&A. We've got a great question from one of our Australian expat viewers in New York City this week, and his question is, given that most central banks are cutting, I'm here in the US, the economy is strong, yet the Federal Reserve is tipped to cut again this month in December, why is Australia not following suit? And it's a great question because, you know, most of the developed G10 countries, central banks are cutting their official cash rates, but Australia isn't. And the latest monthly and quarterly annual GDP numbers that were just released would indicate that Australia's economy is actually slowing. It's been going sideways probably, even though some of the numbers would indicate otherwise. But a lot of the strength in the Australian economy has been driven by fiscal policy, by government spending, government infrastructure, project development, and expansion of the public service. If we look at the underlying numbers, and again, inflation is clearly one of the key indicators that the Reserve Bank of Australia looks at. Most central banks look at inflation, and they have their own their target bands where they would like to see inflation remain. So if we look at the latest numbers, headline inflation was a great result, 2.1% versus, say, 4.9% a year ago. Good news. However, you know, when the Reserve Bank looks at the inflation measure, it looks at trimmed mean inflation, where it trims out or it takes out certain factors which may be transient, which may be removed. So, for example, in Australia, we've had lots of electricity subsidies come into the picture, and that's helped bring down inflation, headline inflation 2.1%. If we looked at trim mean inflation, it was 3.5%, and a year ago it was 5.3%. So the direction still remains the same, and it's, I think, heading in the right direction. Then if we look at a report just released by the OECD, they also share the outlook that the official cash rate in Australia is going to be 3.35% by early 2026. So to come down by 100 basis points. Now, when that occurs, time will tell. But some of the banks see first cuts coming through in middle of next year, 2025. In the main, and some are still forecasting a February rate cut, which I think is potentially on the cards, given these numbers. You know, the unemployment rate is now 4.1%, was 3.8% a year ago, so just ticking up a bit, not alarming, but again, we've got to look at the direction of this. And wages growth is 3.5%, which was 4% a year ago. So if you look at the whole picture, I mean, I know the RBA doesn't want to cut rates, but if we look at all of that, I think the case is definitely being set that we should start seeing some easing in monetary policy, and that'll be good news obviously for people who have mortgages, who have investment loans, who have some level of debt. And as I always say to asset owners, which generally comes with debt, don't despair, because inflation means that your assets are going to be valued at a greater rate, or are going to go up at a greater rate. So it's not all downside, but it's a question of being able to maintain your assets over the duration, and to be able to weather the storm for all of these sort of cyclical changes and volatility in interest rates. If you found this of interest, please subscribe to our YouTube channel and click like. And if you need any help with your own personal situation, don't hesitate to reach out, email us or call us, and we'll have somebody contact you and see if we can't assist you. I'm Unterweger, and all the very best for the end of 2024.